yeah, maybe 2 or 3 more minutes, then we'll get started. So I'll go over like a short presentation first, and then you guys will have a chance to ask any questions you have, either about the presentation or, about the specific topic we want to talk about. If it's regarding like what I'm saying, I'll address it right away. But if it's about something else, I will circle back to it at the end. And thanks for coming, guys. I know some of you guys just joined the workshop for the first time. I'm not sure if I'm going to share it on YouTube or not, but I will for sure share it here so that you guys can have access to the replay. Basically, what we're talking about today is the blue chip portfolio strategies and how I personally run my blue chip portfolio or the client portfolio that I help manage. So the first thing to actually figure out is like, are you trying to grow your portfolio or do you actually have a big enough portfolio to live off of, right? And for most of us, unless you're sitting on like multi six figures or a few seven figures inside crypto, it's going to be very hard to just live on DeFi income. The reason why is the more yield you're trying to get, oftentimes you're going to be taking on more risk. And if there's like a huge market dump, you could see a big drawdown on your portfolio if you're taking on too much risk, right? So that's the first thing to understand is like the safest way to live off of your investment is to actually have a bigger investment portfolio, right? Of course, it doesn't happen overnight, but that's what we're working towards. I have a big enough portfolio where it's enough to cover my living expenses if I choose to just spend the earnings I make. But at the same time, I'm still trying to grow my portfolio. I would say I'm in this second stage where the portfolio is growing itself. If you guys have a smaller portfolio that is under six figures or even like low six figures, and you're trying to grow rapidly, the safest way to do it is to use the active income that you get from other sources and then you put it into DeFi, right? So the reason why is very simple. If you have like 100K, for example, earning a 20% APR is only 20K per year, right? That's actually quite a decent amount of money for most people. If you have like $1 million in your portfolio, earning just 10% is like 100K per year, right? So this is why like the most sustainable way is to grow your portfolio. And then once you have a bigger portfolio, you could live on it more comfortably, right? And yeah, your active income could be from a variety of sources and it depends on what edge you have as well. If you're like a full-time crypto guy, maybe you're farming different airdrops or you're working with different projects, then that's your active income that you're putting in, right? Or if you own a business, if you're working a job that is unrelated to crypto, that's your active income source that you would be investing into DeFi or just doing stuff like dollar cost averaging into Bitcoin. And then once we have that DeFi portfolio set up, that's what this course is mainly focused on, right? We want to take that income and reinvest into DeFi and kind of compound our growth. And this doesn't mean that you should be compounding your fees into like high risk investments all the time, right? When it's time to take risks, when the prices are cheap, then we could actually double up on some of our like riskier investments. But if the prices are really high and it's a good time to de-risk, then we want to be securing profits even to stable coins and then doing stuff like lending out stable coins or using the stable coins to farm different airdrops, right? So there's a lot of opportunity inside DeFi for that, especially now that a lot of people are trying to bring the US dollar on chain, right? A lot of banks are building like layer ones, layer twos. What they're going to do is they're going to incentivize you to actually be able to deposit money on their platform so that you could earn potential airdrops and stuff like that. So it doesn't have to be like higher risk altcoins when you guys are reinvesting into DeFi. And then once your portfolio is at like a comfortable size, for example, my portfolio right now, I'm at the stage where I don't really need to reinvest my income if I don't want to. If the market gets cheap enough, if Bitcoin drops to 50K, for example, then I will for sure put some of my income that I put aside back into the market, right? But at this point, if you're in like six figures or like mid six figures, depending on your actual financial target, you could actually just reinvest a lot of your income back into DeFi or into crypto in general, dollar cost average Bitcoin, all that good stuff. And the mistake that people make the most is like if you have a smaller portfolio, you have like 10K, 20K, 30K, you're trying to earn like 100% APR sustainably. It's going to be very hard if you're trying to live off of that small portfolio. It's not sustainable to be doing strategies that, for example, squeezing the range on like ETH to USDC or SOL to USDC. I talk about that all the time, right? You could lose a lot of money even though it's a blue chip pair because the strategy is not sustainable over time. But if you're able to generate like 10% APR, 20% APR, the risk on those strategies are going to be much less than if you're trying to make like 50% APR or above, right? So that's something to consider. And of course, it's easier said than done. It takes years if the market is not that good, right? Like what we're seeing, the altcoin market this year so far has not been particularly great, especially if you're just a buy and hold kind of guy, right? If you're not catching new plays, like new tokens and stuff like that. And even if you're investing into new tokens, a lot of people do make money from, for example, Aster, and then they rotate their winnings to stuff like XPL, and then they lose a lot of their earnings as well, right? So it's not as easy as it seems. And for every one person that made money, there's always someone that lost money as well, right? So trading, a lot of times, it's a zero sum game. When you're making money, someone else is buying your bags and then potentially they're going to lose money over time. So that's something to keep in mind. But I think most of us are either in stage 2 or stage 1, where we're trying to rapidly grow our portfolio. And again, the safest way to do it is actually not to dial up the risk too much, especially when the market is kind of trading at the middle of the range, but to actually put more income over time into DeFi, right? And I'll share a few strategies that I'll be going over in this workshop that is kind of going to give you a better risk adjusted return based on where we are at in the market right now. But before we dive deeper into the actual strategy, again, these two charts are very important to understand. And the first one is the more assets you add to your portfolio, the less risk it is and the less standard deviation or the volatility of your portfolio is going to be, right? For example, if you guys are just buying and holding Dogecoin, you're basically fully exposed to Dogecoin price action versus if you're spreading out your bets in like Bitcoin, Ethereum, Solana, BNB, maybe some higher risk stuff, Dogecoin, and these lower caps like Pendle, Arrow, Aave, and stuff like that, right? But this is the idea. If you diversify your portfolio, you're going to take on more the market risk rather than the asset specific risk. But one thing that I will highlight though is that even though it makes sense to diversify if you guys are yield farming altcoins, we want to be very careful with the assets that we pick, right? If you guys recall, the LP pyramid says that the most important thing is the asset selection. If you guys are providing liquidity for stuff like Arbitrum, that bleeds out over time, it's very likely that you're going to lose money over time, right? Compared to if you're yield farming stuff like maybe SOL to USDC or ETH to USDC. So there is a point you want to try your best to avoid tokens that don't really have like good fundamentals behind it or like a good compelling reason why people would actually buy and hold that token, right? So even if you're diversifying, you definitely don't want like equal weight on different assets either. Like let's say you pick out 10 assets, you don't want to just buy like 10% Bitcoin, 10% ETH, 10% Solana, and then maybe like 10% pump because you think that pump is a good asset, right? You kind of want to weight like different assets based on your risk tolerance. So that's where the sizing comes in. Most of the time, it is safer to do like, for example, 50 to 80% or even 100% into stuff like ETH and Bitcoin. And then the rest is into these other altcoins if you want to participate in like the altcoin market, right? And again, yield farming altcoins are definitely optional. You don't have to be yield farming altcoins. And if you didn't, you probably have done very well in 2025. But if altcoins do take off in like for the rest of the year and for the next 6 to 12 months here, by yield farming altcoins, we could potentially be looking at least, maybe 2 to 3x or even 3 to 4x on our portfolio. So where there's risk, there's reward to be had, right? So it's up to you how you decide to structure your portfolio, how to balance it. And I'm just sharing like what I've been doing, what I do for my clients. And then you could decide which assets you want to pick, right? But one way to also think about this is that you could weigh your allocation based on the market cap as well. Since Bitcoin is like really high market cap, you should be putting more weight into Bitcoin. Bitcoin currently makes up about 59, 60% of the crypto market, right? And then Ethereum makes up about 13% currently. And if you add BNB and Solana, the three of them make up about 20% of the crypto market, right? So technically, you could be having a portfolio of Bitcoin, ETH, Solana, and BNB, and then you're already exposed to like 80% of the crypto market, right? And then the other 20%, you could do like different stuff like stable coins or other altcoins. It's up to you how much risk you want to take. And the more risk you take, the more potential reward you can have, but also the higher the likelihood to lose money in the market, right? But one thing I do want to highlight also is the more asset you put into crypto, and if you're all in into crypto, you are taking more risk simply because sometimes the crypto market is just weak compared to other markets, like what we're seeing in 2025 with the altcoins. They are particularly weak. So this is what I recommend a lot of people do is you want to at least have some exposure into other markets like the wider stock market or different assets like real estate, gold. An asset that I don't really like are bonds simply because the return is just not enough to cover the inflation or the rate of money printing or the money supply that is increasing, right? The only reason why you might want to consider bonds is like you're near retirement age and you're trying to protect some of your portfolio. But for most investors, if you have at least 10 years or 20 years of runway, you don't really want to too heavily allocate to bonds, right? And again, this just shows you that the more asset classes you add to your portfolio, the less volatility there is in your portfolio, and that the chance of you losing money in a given year is going to drop as well. And it's very important to understand that in investing, your growth is not going to be in straight line, right? With DeFi, we are still earning yields. Maybe our portfolio would be down, but not going to be down as much as, buy and holding strategies, right? Simply because we're earning yield, even though our net profit might be negative for the year. But if the assets do trend up over time, then that's when we would make our profit, right? So there are down years in crypto, as you guys know. There's a bear market that usually lasts like about a year or so, right? So we do need to keep that in mind. I think so far so good. But in terms of the specific LP strategy, it depends on mainly a couple things. The first is your market outlook. The second is the risk you're willing to take. And the third is the asset you're swapping from. If I'm swapping from stable coins, then the way I would deploy into each pool could be completely different. If I'm deploying, for example, I have a client portfolio that I manage. I am deploying Ethereum and I'm yield farming Ethereum to USDC. And a big part of it, we chose the nested LP setup and the bullish LP setup. The reason why is because we have a bullish outlook on Ethereum. I don't want to be locking in a ton of Ethereum profit at around $4,000, right? I'm expecting Ethereum to go up to that $7,000 to $10,000 zone. Maybe it would happen. Maybe it wouldn't. No one knows for sure. But it seems like, a lot of companies are buying Ethereum. Ethereum is getting more and more adoption. Stocks are coming on chain. A lot of assets are coming on chain. So it stands to reason that Ethereum is a pretty good bet when it comes to like a blue chip assets, right? Compared to a lot of other layer one blockchains, Ethereum is definitely a more, you would call like a safer bet. So for a bullish LP, the reason why this LP is good is because if you set a really wide upper range for this particular position, let me pull up the client portfolio. For this particular position, for example, right? we have a range of about the 2,500 to 100K for wrap ETH and USDC, and it's still earning us about like 10% APR per year. So it is greater than just staking Ethereum or lending out stablecoins separately. And the worst case scenario is that it dumps out of range and then we're going to be stuck with more Ethereum. Or if Ethereum goes up rapidly, we're just going to make more stablecoin profit, right? So it's not a big deal if we lose exposure to some of the Ethereum. So if I pull up the impermanent loss calculator here, what we are going to be able to calculate is the impermanent loss that we would suffer. And let's just use 100K value deposit for this example. And then we could put like upper range at 100K, lower range at, let me double check here. So you can see a wider range like this. If the price movement is actually not that much, then it's still beating just holding in the market by a pretty wide margin, right? And I believe if we click in here on Metrics Finance, you're able to see that the deposit price is around $36.90, and then the current price is around $4,000. So there's about like almost 10% of price movement, but there's barely any impermanent loss, right? The reason why, again, is because the ranges are so wide and we're still earning like a higher APR than just lending and staking, and you're not exposed to any leverage, right? The only risk you're exposed to is the smart contract risk for Uniswap, which again, you can buy insurance for, and also the USDC custodian risk, right? As long as these two are safe, the risk for this particular LP is quite low. But I do want to share this. One sec. Let me look at the range. So min price is, like I said, 2,500, right? So if I change this to 2,500 and deposit price is around 36.90, so 36.90. And what you will notice is that if Ethereum goes up to $10,000, we will suffer a roughly 17% impermanent loss, right? But the benefit is if Ethereum does not go that high, let's just say it goes to only $7,000 this cycle, and then the impermanent loss would be less. Or if it goes up really high and then drops back down to $4,000, we would have not round tripped our bags and not actually earn any profit in the market, right? If you just buy and hold, you're going to round trip your bag if you don't know like when to buy and when to sell. And that could become really tricky, especially because we could never know what's going to happen in the future, right? In this case, we would be happy to be dollar cost averaging out of Ethereum, even if the price goes to like a really high target of, let's say, $25,000, right? You would have been better off holding by a wide margin. But the reason why the risk and reward for this strategy is still good is because for this particular portfolio, we are still running like crypto to crypto pairs. And then we're also holding some Ethereum on the side, right? So even if Ethereum goes up by a wide margin, it's totally fine. We're actually de-risking because we're selling some Ethereum all the way up, right? And the wider your range, the less impermanent loss and the less aggressive the conversion rate would be. So we're slowly dollar cost averaging out rather than like a tight range strategy. You're actually dollar cost averaging out much faster, right? So maybe my average exit for this case would again be much better than the average exit for like a tighter range strategy. So this is why the bullish LP could be great if you're looking to lock in some profit right now, but maybe you don't want to sell the whole amount, or you're fine if the price dry down and then you want to accumulate more ETH in the process, right? So that's the worst case scenario. If the price draw down, we end up with more ETH while we're earning some pretty nice fees in the process. And again, the fees could spike depending on what we see in the market. If I click simulate pool on Metrics Finance, and again, you guys can use like other tools to track as well, like Crystal or Revert if you don't have Metrics Finance, because the price is at the peak concentration, the APR is not going to be that great. It's about like 10 to 12% right now, right? But if the price do spike to, let's say, $10,000, then the APR would be elevated temporarily, right? We actually don't know because a lot of people would chase a range upward to try to get the APR. But I would expect roughly 10 to 20% APR with a wide range like this, especially if we see huge price movement upwards. And of course, we actually don't know which strategy is going to outperform in the market until like we see the price action, right? If the market price is very volatile, like what we saw in the last couple of months, price went down aggressively, but then also went back up aggressively, then a wide range strategy like this would outperform compared to a tighter range strategy. But if we see like a very boring market, like what we saw in the bear market, of course, a tighter range strategy would outperform in that case, right? Which brings me to my next point here. If you want the best of both worlds, you could consider like a nested LP setup. So we have a wide range LP here. And in this case, we're trying to slowly sell our Ethereum and not too aggressively. That's why we're going with a wide range bullish LP. And then we have a tighter range LP here to try to actually earn more fees in the process. And this is the exact setup that you guys are seeing here. This is this nested LP that has a tighter range. You can see APR is greater than 10%, it's around 25%. And when I say tighter range, it's still wider than what a lot of yield farmers use, right? Because if we look at the range here, the price range is still at around 37.50 to max price of $8,000. So this is also a bullish LP because we want to slowly sell Ethereum on the way up. And depending again on the asset that you deposit and your market outlook, your ranges could be very different, right? But even a wide range like this so far is able to generate 25% APR, beat holding in the market. And it is showing a negative US dollar profit and loss simply because we deposited at this $4,600 mark, right? For the goal of this LP, it's not really to try to make a US dollar profit. We are good with the price breaking into each way because again, if the price drop, we're just going to earn more ETH in the process. If the price goes up, we're going to earn more USDC in the process, right? You can see compared to holding, we're still up about 700 something dollars compared to just holding in the market. If we just held the asset that we deposited in the first place, right? Which is about 6 Ethereum and then 11K USDC. So this is how you can get like the best of both worlds when you guys are yield farming pairs like SOL to USDC or ETH to USDC with a nested setup. And you guys can take the time to read like the pros and cons for each later. But basically, if the price dropped to the lower side, if you were deploying USDC at the current price, for example, then the drawdown would be much more than if you had like a bearish or a neutral LP, right? Because the reason why is, again, if you're sending a bullish LP, you're buying more Ethereum if you're swapping from USDC when you're entering into the pool, right? So it makes sense if Ethereum drops, then based on your initial investment, you would lose more money in the process. I could run that simulation for you guys to see right here really quickly, but you guys should be very comfortable using this tool if you're yield farming because we want to know like the expected outcome of a particular pool before we even deploy, right? So if the price now, for example, let's say we deposited at 4K at roughly the current price, you set a bullish range of 3,500 to maybe 8,000, kind of what I was doing with the client portfolio, right? But let's just say the price drops to 1,500. You're going to see that you're actually suffering a pretty big drawdown on your portfolio, right? So this is a risk you're taking if you are swapping from USDC. If you're not fine with that, then we don't want the range to be too bullish if you expect a drawdown coming. And we should always be kind of aware that crypto could draw down at any time. We could see like a 60% drop over the next coming months if there's some bad news in the market, right? Where people are just selling for whatever reason. And the price now, let's just say it drops to only $2,000, you're down by 50%. So kind of roughly the same if you just buy and hold Ethereum at this current $4,000 price, right? Assuming you bought like 100K worth of Ethereum, price dropping by 50%, you would have about 50K. But if I expand the bottom range to, let's say, $2,000, right? What you will notice is that at this $2,000 price mark, you would have 60K. So a 40% drawdown rather than a 50% drawdown. So if you're an investor that cannot or are not comfortable with taking that much volatility, then you definitely want to consider setting wider ranges and potentially setting a bigger lower range if you're deploying USDC in the market right now, right? And is it a good time to deploy into the market? It's not the best time, but if you do, again, one of the best strategies that I've run with this client portfolio is simply when the prices drop, we compound more aggressively. And then when the prices are high, we sell more of our fees into stablecoins to de-risk, right? This client portfolio actually got started when Ethereum was trading at 3,300 back in March of 2024. And you can see we're up pretty good on this portfolio, right? There's also a Solana pool that is in the pump and USDC pool. It is a higher risk pool, but this portfolio is around 230K. And we started at around like 150K or so, right? Even though Ethereum's price only went up by, let's say, at the current price, it's up about 22%, while our portfolio is up by like more than 80K on the 150K. So roughly more than 50% on our portfolio. So this is why liquidity pool is very powerful. And you basically don't have to trade at all, right? If you don't want to. So you don't have to time the market as long as the asset go up and to the right over time. That's the most important thing about liquidity pools. If an asset go up and to the right, it's going to be very hard for you to lose money unless you're running unsustainable strategies like squeezing the range, trying to rebalance to chase the range and stuff like that. So that's pretty much it for the basic LPs. But what I do want to share with you guys, I haven't actually made the videos for these in the course yet. These strategies are newer. And what I call this is the butterfly LP. If you kind of imagine, we're kind of like stacking different LPs together. And this is like the body of the butterfly, right? And then there's like the wing on the upper side and then the lower side with the bullish LP. I don't know, maybe you guys have a better name for this. You could make some suggestions as well. But the reason why we stack different LPs like this is it's allowing you to earn a higher net APR on your portfolio. So technically, you could be putting like 80% of your portfolio into like a blue chip setup with this type of LP, right? Versus if you were just doing like one bullish LP or something, you're going to be able to earn a higher net APR on this portfolio, assuming again that this asset would survive in the next 5 to 10 years and stuff like maybe ETH and Bitcoin and potentially Solana. But if you're doing stuff like Solana, I would recommend using less size than compared to stuff like Bitcoin and Ethereum, right? And of course, there's pros and cons. And there's a lot of flexibility with this strategy. If we remove this bearish LP, for example, and then we replace it with a spot stablecoin holding, that's also another way to actually reduce the drawdown. Then it becomes a nested setup, like what you just saw with this client portfolio, right? We have the nested setup, and then we also have this spot stablecoin holding. You can see there's like spot about 20K worth of USDC on Aave that we could deploy at any time when we see a good investment opportunity, right? So you don't have to have like this bidding LP, the bearish LP, if you don't want to. And ideally, if you want the best exchange rate, you could set the lower range all the way at 0 as well. It's going to allow you to get really good exchange rate. So even if I keep the upper range at about, let's just call it 6,000 and then lower range at $0, right? What you will notice is that the drawdown from $4,000, the price that we deposit, to $2,000, we're actually only losing 15% of our entire portfolio in the LP, right? So it's actually a very, very small drawdown compared to a big 50% drawdown in the market. And when that happens, you can always flip this LP into like spot holdings or into a bullish LP to capture that swing upwards. And then you're going to make much more cap gains from that, right? So this could be particularly good. And if we do a simulation right now, you're going to notice that even with a, let's say 6,000 upper range and then 0 range, you're still going to earn a decent, almost 10% APR on your capital, right? And of course, if the price stays near $4,000, so if the price is at $3,000, then I would lose only like about 4% of my capital with this bearish LP. Or if it's staying near, of course, I'm barely going to lose any money, right? So that's a way that you guys could earn quite a decent yield on your portfolio while being more cautious in the market, right? And again, the upside with this is if the price drops really aggressively, the fees are going to print. And then if the price recover, then you will suffer no losses, right? Or you could actually flip to spot holdings and have that fees to actually buy into the LP. And again, if you want zero drawdown, you could just replace this bearish LP with spot holdings. And then it's also, you can balance the risks you want to take. For example, if I put like 50% into the bullish LP, 25% to the tight range LP, and then 25% into the bearish LP, then I am leaning more bullish and I'm taking more drawdown risk in that case, right? But if I want to take less drawdown risk, or if I'm trying to lock in profits, I could be doing like, for example, 50% in the bearish LP, 25% in the tight range LP, and then 25% in the bullish LP, right? So it's very flexible, but there are downsides as well. For example, it's not suitable for higher risk pairs. If you guys are yield farming like meme coins, for example, and because you see that, okay, the drawdown is less with this strategy, you could absolutely still lose a bunch of money if you see like a 90% drawdown, right? So this strategy is not suitable for every single pair, but it is a pretty good pair to be yield farming for like blue chip assets that is likely to survive for the next, until like the next cycle or so, right? And it does take more time to manage these positions because you're now running with like 2 or 3 positions, depending on what you want to do, right? But it's a really good way to even put a larger amount to yield farm inside these LPs. So that's the butterfly LP. And then before we do any questions, again, you guys can ask any questions, just drop them in the chat. I probably need to work on naming these, but I call this the double dipping LP. The reason why I came up with this is because like, okay, maybe the market is quite risky and maybe I don't want to take that much risk, right? Maybe I want to take some risk, but maybe not that much risk. One way to do it is like, let's say I'm seeing a chart like maybe Pendle and USDC, right? Maybe I want to yield farm some Pendle and USDC, but maybe I'm not sure where the price is going to bottom out. I could be doing a strategy like the double dipping LP. Because what I can do in this case is I could either just go for a full range LP or a neutral LP, right? But then when I do that, I would actually need a 50-50 deposit ratio. Compared with this setup, you could adjust the risk you're willing to take. So maybe at this current price point for Pendle, you only want to buy like 10% of your capital. Let's say you have like 10% max allocation in for Pendle to USDC. Maybe your portfolio is 100K, right? So 10K max allocation. Maybe you only want to buy like 1K worth of Pendle at this current price, right? With the full range LP, you don't have that choice. You'll have to buy 50%. So, but with this setup, you could be buying 10K worth of Pendle, for example, and then you could put the rest in this bidding LP. Because the advantage again with the bidding LP, if we see Pendle's price drop to like the 200 days simple moving average, that's another about 40% drawdown. Let me adjust this real quick. So we were saying 10K net into Pendle, right? Yeah, 10K net into Pendle USDC. Maybe we only buy like 1K worth of Pendle and then we put 9K into Pendle and USDC, right? Price upper for Pendle is, let's use, for example, if you want to use like $6 as a max range, I could do that. And then lower range is at 0 because it's a max bearish LP, right? And then current Pendle price is trading at around $3.3. And then deposit price 3.3. Let me change this X and Y axis really quickly. So this is the initial deposit, right? So if we run the math here, we're actually depositing about 20% Pendle. So we're buying 1847 worth of Pendle plus $1,000 of spot Pendle that we initially said we were going to buy, right? And then the rest is in USDC. So about 7,000 something dollars in USDC. But what you will notice is that if Pendle drops to $2, this LP is barely going to lose any money at all, right? It's going to drop down to about $8,000 here for the total value. Your spot holding would lose a little bit more, but let's just call it a 50% drawdown, right? Let's call like 1.65. That's about 50%. You're going to have $7,462 inside the LP, earning some nice yield, while your spot holding would drop from $1,000 to $500. So you would still have about 80% of your initial capital rather than, your portfolio drawing down by 50%, right? So your max drawdown now becomes like 20%. Of course, we are having less spot bag, so then your upside would be limited as well. So we could simulate the upside here. So let's say the upside is a 2x. So let's say it's 6.6. Pendle goes all the way to 6.6. It popped out a range. So for this LP, you would have 9,643, but our spot holding doubled from $1,000 to $2,000, right? So then the math becomes you're up about 16 something percent, not even counting the fees on this entire setup. Of course, the upside will be less, but that's a way that you guys could balance like, okay, you want to bid this asset, but you also don't want to miss out on the upside, right? And some people like to use like 100% bidding LPs. I personally don't like that because you're taking the downside risk without actually a lot of the upside exposure. So when I want to LP an asset, I always want to also think about the upside, right? It doesn't make sense to take risks in the market without sufficient upside. And again, the ratio could change. It could be buying 10% Pendle or like 20% or up to 50% in the spot holdings. And if you go up to 50%, maybe it's going to get closer to the performance of a full range LP, right? But if you do that, the nice thing about this setup is also the spot bag. You're going to get full capital appreciation versus slowly DCAing out, right? Or you could, again, go back to this butterfly setup if you want more fees out of your total holdings. So it's pretty good risk and reward. It's more suitable if you want to take less risk, but maybe you don't want to do a hedge LP setup where you have to deal with like different purse platform and maybe there's like a scam wick that could liquidate you. So if you're yield farming lower caps, this could actually be really good risk and reward as well, because sometimes lower caps would just go up by like, 5x, 10x with a catalyst that comes, right? So this is a good way to actually balance the risk and reward. And you might be wondering, okay, if the bidding LP is even worth it, we could kind of run that simulation right now, right? Let's say we do Pendle and USD. So let's just pick a random one. Let's just say like Pendle USDT here. And again, before you actually deploy, you want to try to pick out like the best APR pool, right? And if we set USDT as the quote asset, I set the max range to 6, minimum range to 0, like what I was just saying. At the current price, of course, the liquidity concentration is less than where it was. And if I zoom out on the volume, 180 days. So this volume is fairly constant, but you can see with this current setup, the current APR is actually quite high at 66%, right? And if I set the custom price to be at $5, at the peak concentration, this pool is still pulling a 20 something percent APR. And again, you don't want to use this strategy, even though it has really good risk and reward, on assets that are likely to actually bleed out and go to zero, right? But assets like Pendle, if you're comfortable with the risk, you believe that it's going to be around for a long time, then we could be employing this bidding LP plus the spot holding to get a better risk and reward in the market. So, and again, even if our average APR is around this amount of concentration, so not too high, but not too low, you're still seeing a 30% APR. So if we see a big drawdown on this bidding LP to $2, for example, you're still going to be left with 8K, right? 8 grand. And if we earn a 30% APR, you multiply that by 1.3, right? Then you would actually be profitable just holding through that drawdown for 1 year And then as long as the price don't dip too aggressively to like close to zero, for example, right? But even if it does, at least you're still salvaging some money versus, being in spot and then losing a ton of money in the process. So in my opinion, if you want to take less risk, but you want to invest in altcoins, then this is one of the ways to do it. Of course, if you don't hold a lot of spot bags, your drawdown will be less, but it's still a good way to earn some nice yields in the process. And the same rule applies, like if prices do trade above your entry, you don't really have to worry about any capital losses, and whatever fees you generate is just purely profit at that point in time, right? So any questions you guys have about like the current presentation or about anything in general? I hope the information was helpful. Also for this, the double dipping LP, this is also good for locking in some profits. If you're trying to rebid a token, you want to lock in the profits. You believe that the token might be drawing down and you're fine with like rebidding a token, right? So let's say you're holding a lot of spot Bitcoin. You could be, for example, selling like 25% of your Bitcoin or however amount that you're fine to take profits on into this bearish LP and then hold the rest in spot, right? So that's a great way to actually lock in your profit. And then the drawdown on this bearish LP is going to be less than like your spot holdings, right? And then if the price keeps drifting up, then you're also fine because you have that spot bag to hedge your upside, right? And this is particularly great for stuff like Solana and ETH. If you're holding a bunch of spot bag all the way up to $250, you can lock in a ton of profits there. And if the prices drop by even like 90%, you're at least going to be left with like a big portion of your portfolio and you're locking in a ton of fees in the process, So that's a great way to lock in your profits. Yeah. But of course, you still want to hold some spot stable coins simply because if you don't, then a token draws down more than you expect. If Pendle goes all the way to like zero 0.5, for example, then the drawdown for this bearish LP could still be at around like 50%, right? So quite a significant drawdown. And the way the math works is that if you actually lose the capital when the market draws down, the good thing is you're still earning fees throughout the whole process, right? So there's zero need to actually rebalance or lock in any loss. But the way the math works is that if your LP capital becomes like from 9,000 drop to 4,500, you would actually need to earn 100% APR over the span of 1 year to make back your initial capital, right? So obviously we want to try to avoid like this drawdown scenario. But again, there's other things that you guys can do to like try to ease this pain when throughout the drawdown. You could be compounding into the pool or adding fresh capital into the pool. That's a great way to kind of like manage the drawdown. And if the asset bounces back, then you'll be able to turn a profit, right? But again, crypto, it is risky. That's why I advocate cross asset diversification rather than being all in into crypto, simply because even stuff like Ethereum in the middle of the bull market, we saw like a 60 something percent drawdown, right? Which is quite wild. And it could happen in the future. We actually haven't seen like an insane drop in the stock market 2008, 2009, right? If stock markets draws down by like 50 to 60%, you could be sure that a lot of these altcoins are going to draw down heavier than that. Yeah.
Hey, hi, Richard. This is Austin.
Hey, Austin. Welcome to the
You-
community, by the way.
Oh, thanks, and thanks for sharing this or
Yeah.
doing the talk. Appreciate
Yeah.
it. I think to your point, I have a question about what's your preferred kind of blue chip LP allocation. I think in light of like what you said, for example, ETH could draw down. I used to be mostly in BTC, but because of the higher yields, I switched mostly to ETH pools, and I'm just these days I'm just thinking about if I should reallocate back to maybe some more BTC pools instead, just in case there is a drawdown. So I'm just curious what you think about blue chip LPs.
So I think it depends on what you actually hold and your market outlook. The reason why I don't like to yield farm Bitcoin that much is like you said, right? The yield is lower and the price swing is also lower. So there's not a lot of good opportunities. Like for example, with ETH, there's a lot of good opportunities to add capital at a cheaper price and to take the swing like up and down, right? So for me personally, and for like some of these blue chip portfolios, what we yield farm ETH USDC. That's how we get exposure to ETH and maybe some like altcoin pairs, right, to boost the return. But we use those fees to just buy and hold spot Bitcoin, either raw Bitcoin or wrap Bitcoin, Coinbase Bitcoin, and just not worry about really yield farming Bitcoin that much. Yeah. That's how I personally do it. Yeah.
Got it. Okay.
Yeah, no problem. And I think like it is worth it to hold like Bitcoin, even if ETH Bitcoin drops really cheap. Would I personally go all in into ETH? Probably not, simply because we never know what's going to happen in the future, right? I would still want to have some exposure to Bitcoin. Yeah.
I totally agree. Off topic, but I totally agree. I'm basically only holding Bitcoin and borrowing against that for liquidity pools, like
Nice.
ETH liquidity pools. So,
Yeah. Yeah.
yeah.
Yeah, that borrowing strategy is good as long as you don't over leverage. And if you watch like the more advanced lessons, you will see that my preferred method is like borrowing when and entering when ETH to USDC is pretty cheap, for example. And then as the price drift higher, I want to keep de-risking and pay back the loan, right? So yeah.
Cool. Thanks.
Yep, no problem. I think if you guys don't have any other questions, we could hop off, and then if you guys do, you could ask now. All right, I think we're good. And again, you guys can ask any questions in the main chat or use the discussion forum if you want to ask more detailed questions, simply because it won't get lost there, and then I could give you a more detailed answer. But thank you guys for coming. I think hopefully the workshop was helpful. And when I get the chance, I will be adding these video lessons to the courses as well. I still need to like do a bunch of stuff like update the mind map and update the course over time. Thank you guys.